Next, let's look at the different products available. So MassMutual, as a company, offers 7 different whole life insurance products. They're core products, which we had them up for a minute on the last example. So with their whole life insurance policies, core products, 7 of them, which are their Whole Life 100 policy, their survivorship policy, their high early cash value product, which is great for strong upfront cash value, their L65 policy, which allows you to pay into the policy up until age 65. You're not required to pay that long, but you cannot go beyond that. That's 4 thus far. Then you've got their 20 pay policy. You can pay into it for a maximum of 20 years. Their 15 pay, maximum of 15 years. Then also their 10 pay policy. Now, when it comes to their products, with respect to the limits, so when I say limits, how do you maximize the cash value of a life insurance policy? Well, it has to do with the premium and PUA ratios. So we've got our base premium. Then we can also add money into LISR, which stands for Life Insurance Supplement Rider. That's a combination of a OYT, 1-year term rider, and then also money going into PUA, so they blend a term rider and PUAs together. And then you've got their AILR, Additional Life Insurance Rider, which is just their pure PUA rider. Now, when I was new in the industry, going over this stuff with my dad, I share the story sometimes. He would ask, or a question he asked once is, hey, I don't care about the death benefit. Can I just pay everything into PUAs? I'm like, no, you can't do that, Dad. They won't let you go that aggressive. You have to have something in the premium. So then the follow-up question naturally that a lot of people have is, how low can I go? Well, MassMutual limitations are this. Wherever you set the underlying base premium, as a company with all of MassMutual's products, they will allow a policyholder to pay 10x the base premium with respect to a total payment. So to demonstrate, we talk about policy design quite a bit. If you have a $10,000 minimum premium, what that means is that MassMutual as a company will allow a maximum payment of $100,000 per year. They will not allow one to go higher than that. So to actually satisfy that design without triggering a MEC, a modified endowment contract, we could go with a $10,000 base premium, a $1,000 term rider, maybe it's $2,000, depends on our age, and then plow everything else into PUAs, and that is often a combination of LISR and AILR when we look at the actual design. But the main thing here is that MassMutual as a company will allow a policyholder to 10x their base premium with respect to the total payment. In fact, when you actually run the illustrations, and if you're in the business, you may be aware of this already, if you try to run an illustration with a greater ratio than 10x, let's say I paid $100K per year in, but I make the base premium $5,000, I can illustrate that. Like I could run that illustration and show it to a client. However, when you scroll to the end of that illustration, or if you look at the warning messages in the software, it'll say warning. This policy design exceeds 10x the base premium. The total payment exceeds 10x the base premium and will not be approved for sale. The mistake has been made in the past where illustrations are shown to clients that look phenomenal because the base premium is so low. It's submitted to start the policy and the company comes back and says, we won't issue this. It's beyond our standard limits. And now the agent has to go show the consumer, hey, here's what the company will allow. It's got a higher base premium. And now we showed something that looked better. It's not a pleasant situation. So good to have awareness there for consumers and agents, really. So 7 core products. Let's continue on here. Next part, we're going to have some fun with this. PUA flexibility, or let's begin with their PUA riders. So with respect to PUA riders, PUA stands for paid up additions, a nice way to accelerate the cash value on a whole life insurance policy. I'll refer to it this way, the way to accelerate the cash value on a whole life insurance policy. MassMutual has an abundance of PUA riders. They have their LISR rider, which again represents Life Insurance Supplement Rider. That again is a combination of money that's allocated toward PUAs and a term insurance rider. This is great to build in PUA flexibility. MassMutual is typically not a very flexible company. We're going to go through their other PUA features with respect to flexibility, but if you have this attached to a MassMutual policy, you've built in a good deal of flexibility that otherwise would not exist. We'll walk through what I mean there as well. Their other PUA rider, AILR, which stands for Additional Life Insurance Rider. This is a pure PUA rider. Now, MassMutual has 3 different types of AILR. They've got their scheduled AILR, unscheduled AILR, and planned AILR. Let's go through one at a time here, beginning with the most popular, which is their scheduled AILR. My personal favorite with MassMutual is doing a combination of scheduled AILR and LISR. You can do the most damage in a good way with that, but let's go through all of them, because if I'm a consumer, I want to be made aware of all of them. Scheduled AILR. We can attach this to a policy when we start. So when you first apply for a MassMutual policy, if that's the company that you're most attracted to, you feel is a good fit, you can add this when starting a policy. We would submit the application with everything AILR on it. You can also add it after you start a policy. You can add it or increase it. But what's important to be aware of here is that that will require medical underwriting. Now, with AILR, level payments are required, specifically scheduled AILR here. So if I start a policy with a scheduled AILR payment of $10,000, it's going to be level each year. I cannot easily bounce it up and down. I'm going to touch on that in a minute. It is due at the same time as the base premium. So for example, if I have a base premium of $10,000 per year and I'm paying that annually, let's assume I have a $10,000 AILR, scheduled AILR payment as well, that must be paid at the same time as the underlying base premium. Good to be aware of that. We also have this 3-year rule. So this is where we're going to go through this chart on the right. What I'll begin with is the 3-year rule is after the first 3 policy years, meaning once we enter policy year 4, we can increase our scheduled AILR payments by 10% per year without any medical underwriting. So what that means, let's assume this is scheduled AILR. Year 1, you pay in $10,000 into AILR. So this is above and beyond any base premium and LISR payments. AILR payment, $10,000. Year 2, AILR payment, $10,000. Same thing year 3. Year 4 rolls around. If you wanted to, MassMutual will allow this. How the 10% increase works. What's 10% of $10,000? $1,000. I could add another $1,000 on top of the $10,000 AILR payment, meaning that particular year, my total AILR payment can be $11,000. And then the next year, it's 10% of $11,000. So I can increase it by 10% per year, which is nice. Not many people we work with do that, just because if someone wants to increase, they want to increase it by a lot more, which I 100% understand. I'm kind of the same way. But it is good to be aware of that because it's a small increase, but it can add up over time. The other 3-year rule has to do with their 3-year window with respect to flexibility around their additional life insurance rider. So this can be a bit complicated and is a huge reason I'll state why we add LISR and AILR to policies, because LISR builds in more flexibility, which we'll touch on in a little bit. So how this 3-year window works is, let's assume 1, 2, 3, years 1, 2, and 3, you make this $10,000 AILR payment. That's what you start the policy with. That's what you pay each year. Year 4 rolls around. You pay in 0. Year 5, what happens? Well, if you want, you can increase your payment back up to $10,000. But let's assume you did this. Year 5, 0. Years 4 and 5, you pay in 0. When year 6 rolls around, that's the 3rd year. At this point in time, you do need to increase your payment or pay something into AILR, otherwise you will lose it. So if you go 3 consecutive years of paying nothing into scheduled AILR, it's gone. In order to attach AILR, if you say, hey, I want to resume my scheduled AILR payments to kick more money into PUAs, MassMutual will come back and say, well, before you can do that, we'd like to put you through medical underwriting again, which is a pain. No one wants to do that. So how we prevent it? Let's assume that years 4 and 5, you paid 0 into AILR. If you resume your AILR payments at $10,000, what happens is the limit resets for another 3 years. What you can also do here, which is kind of neat, can make up for lost time. So you can actually pay in $30,000, the $10,000 in this case for year 6, plus the $10,000 payments that were missed in year 4 and 5. Now, moving forward, beginning year 7, the maximum would be $10,000, not $30,000, unfortunately. As we continue here, let's assume you did something like this. Year 4, you paid in $5,000. Year 5, $5,000, and year 6, $5,000. So years 1, 2, and 3 of scheduled AILR was $10,000. Years 4 through 6 is only $5,000. Year 7, you say, hey, I want to go back up to $10,000. Can I do it? The answer is no. If you go 3 consecutive years, like the first example, it was 0, and you can't go back up. If you do not hit your original maximum, your new maximum would now be $5,000, the maximum that you paid into the policy during the prior 3 years. A little confusing, it definitely can be, but hopefully this provided some value in that respect. So that is how scheduled AILR works. One more thing actually, if in the first 3 years you miss a payment, let's assume in year 3 you pay in 0, or in year 2 you paid 0 into AILR, it's gone. You cannot resume it. So we do need to get past the first 3 years of consistent scheduled AILR payments. If you attach LISR to the policy, because that allows you to bounce payments up and down every year without any medical underwriting, that's a nice safety feature to build into a policy where I can make up for lost time and I don't have to worry about any of these windows that exist with respect to the AILR rules, which can be complex. So that is a quick overview, an overview on AILR, on scheduled AILR. Next, let's progress into unscheduled AILR. This one will not take as long. It's pretty straightforward. This is typically attached to a policy at issue when you first start it, so added when starting a policy. If you said, hey, I want to start this policy off, I want to pay in 10 grand per year, but day 1 with unscheduled AILR, I want to add another 25K, you can do that no problem. You can use the underwriting that you went through to start the policy and just pop that right into the contract. Now, with that said, beyond that, if you say, hey, I'm a couple years into the policy, I've got another $25,000, $50,000, a big sum of money, I want to throw it into my policy because I'm beyond the first couple of years, I'm beyond the expenses, I just want to dump money into PUAs. Can I do that? The answer is yes, but underwriting will be required, unfortunately. Now, there is some additional rules to this. If your AILR payment, your unscheduled AILR payment, is $25,000 or less, or under $25,000, $24,999, what happens is the underwriting does not involve blood and urine. It's not that intensive. It's paperwork. Well, they do ask some medical questions. It's an oral mouth swab, where sometimes the company will mail you a kit, but you can do it on your own, and then you have to take a selfie video so they know it's you, not a video, a picture, and then mail it back. And then sometimes they send a nurse out to take the oral swab. They also take height and weight. If it is $25,000 or more, within a 12-month window, by the way, it's the same as above, but then in addition to that, we do have to go through a full medical exam, where a nurse comes out, takes blood and urine, just like what would happen when we're first starting a policy. Additionally, the company may order medical records, like they will when we first go through the underwriting process to open a policy. It's kind of a pain, can take time. If our health has declined, they may reject the unscheduled AILR payment, or it may be rated, so we do want to be mindful of that. Now, if we do go through a medical exam, medical exams are valid with most insurance companies for up to 12 months. So what that means is if I go through a medical exam today to add $25,000 to my policy, and then 6 months later, I want to add another $50,000, assuming the policy does not mech out and I'm within the limits, I can do so and I can use that same medical exam I went through if I'm within that 12-month window, which is good to be aware of. So the unscheduled ailer provision does exist. There's not many people who use it because it is complicated with the medical underwriting there. Let's progress on to the last ailer feature, which is their planned ailer. So this guy was introduced early 2020, really in an effort to build some additional flexibility into the policy. Because MassMutual traditionally is an inflexible company. Just when you look at their whole life insurance products, especially compared to other carriers out there. Planned ailer builds in some flexibility. Now, when we start a policy, that's when we have to attach it. It needs to be underwritten up front, meaning the company will approve the maximum planned ailer we can attach to a policy. For the sake of round numbers, let's assume it's the same $10,000 we used with the scheduled ailer payments. Now, this allows unscheduled payments, meaning I can just dump money into a MassMutual policy at leisure, kind of, sort of. You'll see what I mean as we go through this. It's not, in my opinion, as flexible as Guardian, which will allow me to add unscheduled PUAs through my mobile app, online account, mailing in a check. Extremely flexible. I just pop it in anytime I want. They're getting there, but they're not there yet, in my opinion. So with the planned ailer, I can add unscheduled payments with some contingencies. There's a limit to how many I can send in per year. Three times per policy year. So planned ailer, let's assume that the maximum limit you're approved for upfront, because you have to be underwritten for it, is $10,000. What that means is during a policy year, say the first year, you can add a total of $10,000, which is broken up into a maximum of 3 payments. It can be one payment if you just say, hey, I got the whole 10 grand, I want to send it in right now. No problem. But if you say, hey, I want to send 5,000 right now, 6 months later, another 3,000, and then another month later, another $2,000. You can do that. But 3 payments maximum is a rule they have there. The annual amount is underwritten up front, and we have a 2-year rule here, which is very similar to the scheduled ailer rider with their 3-year rule. How this works, let's assume you're approved for the $10,000, let's assume that, with planned ailer. Years 1 and 2, you pay in $10,000. If you get through the first and second year, now all of a sudden years 3 and 4, you can pay in $10,000 per year in planned ailer. Before we move on to years 3 and 4, years 1 and 2, let's assume you did something like this. Year 1 was 0, year 2 was $10,000. You satisfied the requirements. The planned ailer rules stipulate that in any 2-year window, if you make the maximum planned ailer payment, which is the amount you were underwritten for, $10,000 in this case, now you have another 2 years to hit the maximum again. So it could be 0 in year 1, 10K year 2, could be flip-flopped. Maybe it's 10K in year 1 and 0 in year 2. If you did that, the same exact thing would apply. Or now, let's assume this, 10K year 1, 0 year 2. Years 3 and 4, you can pay in 10K per year. Let's assume year 3, you paid in not 10K, so it was $5,000, and then year 4, it was 0. That 2-year window, you did not hit the $10,000. You hit $5,000 maximum. So what that means now is that the new maximum moving forward is $5,000. If you want to increase it, it will be subject to potential medical underwriting. Their language is a little bit different there when you read the planned ailer rules, but there's windows. We can make a maximum of 3 payments per year. The nice feature is MassMutual in the past would never allow unscheduled PUA payments. They would, but it's through their unscheduled ailer, which we just went through, and we know that that's not that flexible at all. There's almost always some type of underwriting. So this does build in some flexibility, which is nice, but it's not quite where other carriers are yet. I have seen them working in this direction, which is nice. But with all that said, a lot of info there, right? With all that said, their life insurance supplement rider is a beautiful feature to attach to a MassMutual policy. If you're attracted to MassMutual due to their company size and such, that allows you to adjust payments one time per year, every year, provided the adjustment fall on your policy anniversary date without any medical underwriting at all, which is really, really nice. We do need to have term attached to the policy, but that's a nice feature. So on that point, let's look at the preferred design here, and we're going to illustrate the sweet spot with MassMutual policies too. So this is my personal preference and what a lot of people we work with do. Preferred design. You've got a goal of maximum cash value and you are attracted to a MassMutual policy. You want more flexibility because those AILR rules we just went through, you look at it and think, hey, that's kind of complicated. I don't know that I want to keep track of all of that. And you don't have to. Not if you're working with us or an agent, they'll always be able to track that for you. But as I mentioned before, I like that AILR and LISR blend. Blending them both together, once you get beyond the first 3 years, if you make it with a consistent payment, you've got added flexibility with AILR. If you don't get beyond those first 3 years, or any 3-year window, you've got LISR as a nice backup. We can adjust payments up and down really anytime beginning the second year, which is nice. Here's the thing with LISR though. You can make an adjustment one time per year, every year, if the adjustment falls on your policy anniversary date. So what that means is if you start a policy January 1st, 2022, then January 1st of each year is your anniversary date. That's when your premium is going to be due. At that point in time, you can adjust your total payment for the year. Now, it doesn't have to fall on the exact date. It can be 30 days before through 30 days after, so you have a nice window in that respect. But you can do something like this. Say year 1, you're paying $50K into a MassMutual policy. Year 2, it's $20K. Year 3, $30K. We're bouncing up and down. Years 4, 5, 6, $10K per year. Going past that 3-year window that we saw with AILR. And then year 7, I pay in $100K. Maybe I make a big MEC catch-up payment. As long as I don't MEC out the policy, I can do this kind of stuff. So I can build in a lot of flexibility with the MassMutual policy. If I am comfortable with a one-time per year payment adjustment, I can do a lot of good with the MassMutual policy with respect to flexibility and a maximum cash value design. So, sweet spot. We're going to look at 2 examples here. Number 1, 15 years or less. MassMutual has a lot of products, which we went through earlier, with different guaranteed rates and variable loan interest rates. With MassMutual, they've got their 10-pay product and 15-pay product, which after the recent 7702 change occurred, they really geared those 2 products for cash accumulation. And they've outright stated that as a company. They're saying, hey, if a consumer is interested primarily in cash value, we designed these products to accommodate that. You will see higher internal rates of return. A big reason for that, this is an interesting piece of information, is that those 2 products have lower PUA rider fees than their other products do, which will provide greater upfront cash value, but also how the crediting works with limited pay products, we see greater long-term performance as well. But the drawback to these options is we can pay into it for a maximum of 10 and 15 years. If I say I want to be able to pay into a policy for a long period of time, that might not be the best option. I like to see everything, compare and contrast, but that might not be the best option if I want to fund it for 30 years or something like that. If you said, well, I want a policy with maximum upfront cash value, I want a minimum premium, maximum cash value blend, call it a 10-90 split, 10% premium, 90% PUA, which is as aggressive as MassMutual will allow one to go. And I want to fund as much money as long as I possibly can. MassMutual is one of the few companies you can do that with and not trigger a modified endowment contract. Now you can't do it with those 2 products, the 10 and 15 pay. You'll need to use a product like their Whole Life 100. You could do it with their high yearly cash value product. You could do it with the Whole Life 65, depending on when you're starting a policy. If you're 20 years old, that gives you 45 years to pay into it. But if you want to go beyond age 65, that's not a good option. But we're going to look at two different options here. Before we do so, just the one thing here that I'll often mention to individuals is MassMutual works beautifully if you are comfortable and disciplined for that one time per year payment adjustment. If so, it works great. So let's look at some examples. We'll start with the strong internal rate of return example. And actually, I want to hit on something here. We'll start with the 10-pay product, and I brushed over this, I didn't even mention it. This guy, the 10-pay policy. You can add LISR to it, but it does hinder the design, the performance. It's not ideal compared to what that product could be. However, if you add RTR, which I'm sorry, that represents renewable term rider, it's term insurance. This is a cost-effective way to raise the death benefit and raise the MEC limit on a life insurance policy. It's got some advantages, but it's not LISR. It doesn't have the same provision as LISR where you can bounce payments up and down each year without any medical underwriting. So where I'm going with this is this design works very, very well with a 10-pay if someone is extremely confident that they don't need or want flexibility. If it's you said, hey, I'm comfortable paying X amount of dollars into the policy for 10 years, and I don't need flexibility. Or it's for 7 years, it's for 5 years. You don't have to fund it for the full 10 years. But you know with almost absolute certainty that you're not gonna need or want to bounce payments up and down each year. So let's start with that actually. Here's a 10-pay funded just for 7 years. And what do you notice here? We see RTR, and then we see LISR. With the design limitations, and this is somewhat specific to the 10-pay as well, with RTR, it hums. You'll notice this is identical to the 10-year funding scenario. I just cut it down to 7, but the 10-year funding scenario we used for the non-direct and direct recognition study. Here we go. Beautiful. Funded for 7 years, nothing thereafter. Here's your internal rate of return, annual and average, compared to adding LISR to the policy. So this gives them flexibility. But in this particular case, there's a cost to it. And the cost is higher than I like. But same thing with the 7-year funding. Break even is really year 5. I don't know why I have year 6 highlighted. Probably too late this evening, but that's okay. What do you notice? Right off the bat, there's a difference in the internal rate of return. As the years pass, the difference is not drastic, but it's noticeable. I've got significantly less money up front. If I look at it 30 years down the road, if I look at the average IRR, 4.41 compared to 4.35, excuse me, the cash value difference, it's about 35 grand. So I could view it as that $35,000 is the cost to add the flexibility to the 10-pay product. Personally, I'm a fan, if I like that 10-pay product, to go with the RTR option because it can juice the upfront cash value, long-term cash value, looks better overall. If I want flexibility, that's where I like the 15-pay product. So here we go. Here's the 15-pay, which has very comparable internal rates of return to the 10-pay, a little bit less, but one can pay into it for 15 years. And additionally, both of these models here have LISR attached to the policy, which means if this is you, you can bounce your payments up and down each year. These designs differ very, very little. And you can tell in the first year, $100,000 goes in. This is a pure 7-year fund. So minimum death benefit fund right up to the MEC limit each year. You can do that with a 7-pay. And then stop. What reduced paid up, paid nothing in thereafter. With this design, the 15-year fund, what I had to do differently here, you'll see it a little bit higher death benefit, is we slightly overinflated the MEC limit to make sure a MEC never occurred, not beyond the 7th year, not through year 15 or any time, but a little bit less cash value as a result right off the bat. And he can stop funding after 7 years, with breaking even between 4 and 5. Let's compare this actually. Same policy here, just one we're funding it for 15 years with a slightly different design. But what I like about this option is we've got lister attached to both of them. So if this is you, we've got the 100K per year going in, but you can pivot each year. I can pay $100,000 this year, $50,000 next year, $30,000 for 3, then bounce it back up to 100, $150 one year to make up for lost time with MEC catch-up payments. You can be creative and do that kind of stuff. So that's the 10 pay and 15 pay option. Let's look at them side by side. So 10 pay with RTR on the left, and then the 15 pay with lister, which you can go through year 15, and you've got the ability to bounce payments up and down. Very similar when we look at these two. You will notice the 10 pay stronger. So if you said, hey, I just want to maximize every penny I can get out of this thing, and I don't need the flexibility, that's your option. And if you were gravitating toward MassMutual. If you said, you know, I might want to go beyond 10 years. I like the flexibility. I don't know that I'm going to make a consistent payment every year. Life happens, whether I'm paying in $1,000, $10,000, $1 million per year, whatever it might be. Like, I'm not comfortable committing to that amount. Give me some flexibility, Steve. Well, we'll do just that then. This way, the 15 pay gives you very comparable cash values, but also the ability to pivot up and down. And both of these products are designed for strong internal rates of return and lower PUA fees. Now let's look at that other sweet spot. That was option 1. A lot of info here, but this is meant to be a deep dive. Option 2, you want a minimum premium, the ability to fund as much money as you can for as long as possible. So I'm going to look at their higherly cash value product here. We don't look at this a whole lot, but let's have some fun. And here we go. So I ran 2 options here, all with the same product. There's 3 examples, but it's 2 options. We've got 1, the higherly cash value policy, where we are funding for 5 years, 10/90 split, breaking even between years 4 and 5. The higherly cash value product, we've got about 92% cash value right off the bat. The example to the right, the only difference here is that we're paying into it for 25 years. And this could be 45 years if we wanted to. We can go longer than that. But we're going to stop at age 65. What do you notice at the year 5 mark when you compare these two? They're identical. There's no change at all. The only difference here is with the middle example, we elected to continue to make payments through age 65. We wanted to keep feeding the beast. A nice thing about MassMutual, if the policy is designed properly, is you do not need to decide this up front. I could select this option. Maybe my intent is to pay into a policy for 25 years, but then I say, you know what? Life happened, or I just don't want to pay into it anymore. Can I do this? Can I stop after 5 years? The answer is yes. Maybe I go with this option and I continue to pay into it for 10 years. You can build a policy to be extremely flexible with Mass. When I say flexible, keep in mind we do have that 1 time per year payment and payment adjustment. These are all annual payments. It can be broken up monthly too, or quarterly or semi-annual for transparency, but they do ding you with a hefty fee if you pay any frequency other than annually, which we've got some other content on that. The example on the far right is the exact same policy, but what I wanted to illustrate here is a worst case scenario based on the guaranteed values, which with this product is 3%. We're mixing it up. We can make this video 3 hours if we wanted to go into everything because there's so much information. But as we look at this, there's your guaranteed values, breaks even in this example between years 11 and 12. If we stop the funding at 7 years or less, the break even would fall right between years 9 and 10 with this product. There we go. Year 25, I've paid in $2.5 million. Guaranteed, I've got almost 2.9, paying nothing thereafter, and continues to grow. Personally, I like looking at the guaranteed and non-guaranteed values, even though we always see it do better than the guarantees. I'm conservative by nature, so I like to look at that kind of stuff. So a lot of info there, but with their sweet spots, maximum internal rates of return, 10 and 15 pays, especially if you like the idea of funding it for 7 years or less, you can hit a home run in that respect. If you say, I'm going to keep feeding this thing, like I like that idea, I don't want to have to go through the early years and expenses again, there are other products that accommodate that. Particularly the Whole Life 100, as you can do it literally up until age 100. The high yearly cash value allows you to continue to make payments until age 85. You've got a lot of flexibility there. So we are getting near the finish line, I promise. A lot of good stuff here. To provide some awareness on their online account features here, this is important, this next piece. If you're considering a policy and you want to know, hey, what's it look like? What's like the actual user interface or just some key points of awareness? So here we go. Consumer awareness. Funding. It is convenient to pay both a base premium and PUAs at the same time. And we kind of covered this when we went through the PUA flexibility. What MassMutual is not that great, not that equipped for, in my opinion, is if you said, hey, I want the ability to pay in $100K per year, I'd like to commit to the minimum premium, call it $10,000 per year, and then at my discretion, I'll just add more money into PUAs. You can do that with other carriers. Guardian's a great example of that. With MassMutual, you can kind of sort of do it with their planned AILR, but that's not that great. You've got the 2-year window, the 3 payments per year. If you said, hey, I'm good with a one-time per year payment adjustment, like I'm comfortable, I've got the means to do that, that's where it's very, very convenient and you can really maximize just the performance and what MassMutual offers with their products. You can really take advantage of that. Annual adjustments, if you're comfortable with that one-time per year payment. Now, what I'll add as well, how that works is you don't need to do anything on your end other than let your agent know, here's how much I want to add this year. So for example, if you work with us, or if you're considering working with us, what we do in this case is when we have our review calls, or if you reach out and you say, hey, I paid in $100,000, or someone actually just reached out today. He paid in $5,000 last year, and he said, it's going to be a stretch this year, and that was it. So I just reached out, I said, hey, no problem at all. Your policy was designed with a minimum premium. He can pay between $700 and $800 this year. He can even pay $0 if he wanted to. But he said, hey, around the $700 range, that would be great. So his anniversary date is coming up. On the back end, us as the agents, we just adjust that amount downward, and then his online account updates, and he can send the funds in once it's updated right through the online portal. So you've got an online portal. As far as how you can make premium and PUA payments, you can do it through your online portal. You can mail in a check. You can also do it via phone. That's consistent with deposits. Also with policy loans, you can facilitate all of that through your online portal if you wanted to. A lot of people do that. However, we encourage everyone who works with us always to let us know when you want to take out a policy loan. And the simple reason is if you want to take out a policy loan, our office, our client relations department knows exactly what to do. They'll reach out, in this case, to MassMutual and say, hey, so-and-so would like to take out a policy loan of $10,000. We'll provide the ACH paperwork. This way we can ensure it's direct deposit. We send it directly to our contacts at the company, and it's a smooth process. Why I mention that, because you can use your online portal and request a loan right online. Is what happens sometimes is one will request a loan, they want it to come to them via direct deposit, and then the company mails a check, the person's out of town, it sits in the mailbox, frustration occurs. It's like if we can prevent that, we want to. This is why we've got our own client relations department in place to prevent some of those issues. So, continuing on, best suited for level funding and one-time per year payment adjustments. For example, like the scenario we saw, the $100K per year for 25 years, that's MassMutual's sweet spot in my opinion. PUA limit, 10x the base premium. That's the most I can pay into the policy. So if I have a $10,000 base premium, I'm starting off, the maximum I can pay into the policy each year is $100,000 per year. The only exclusion, the only exception to that is one with MEC catch-up payments. So for example, if you paid in $100K year one, say that's your limit, then year two, you paid in $50K, where you could have paid in $100,000, but you did not. but your MEC limit was 100K that year, what happens is the next year, if you wanted to, you could pay in a total of 150K, making up for lost time. The IRS allows you to do that when you look at the MEC rules. We've had a lot of people that have done that, and the insurance carrier will allow you to exceed that 10X limitation when we're making MEC catch-up payments. We've never run into an issue with that. 1035 exchange, which is rare, but if you're doing that, the total first-year deposit, including what you pay into the policy and money coming over from a 1035 exchange, can actually exceed or cannot exceed any more than 20X the base premium. And then this guy, which is what we kind of touched on already, MassMutual is ideal for a 1090 split design, 10% premium, 90% PUA, where you want to fund it for a long period of time. You can do a lot of good with them. So to wrap things up, what I want to touch on is some actual performance, which is very important here. So when we look at cash value performance, or any whole life insurance policy, we have projections, illustrations. Here's what your money will grow to if you continue to pay X amount of dollars in, and if the dividend rate stays exactly where it is forever, here's the cash value buildup. Like those Excel charts you saw, with the exception of the guaranteed values, they were all based on the company's current dividend rate, and things will change over the years. The dividend rate will adjust. Here's what I want to touch on. When we look at illustrations, MassMutual, if you're just looking at illustrations, they project strong values. They do not project the strongest in the industry. Some carriers do project or illustrate greater values, but illustrations, I like them just to kind of look at things, just to gauge it, but at the same time, you can throw them out the window because that's not what's going to happen. What I like to look at here is actual performance. And Mass and any of the four major mutual companies have consistently delivered. So we've got historical studies that examine policies with MassMutual that were issued in the 1980s, 1990s, 2000s, and then I've got a lot that I put in place between 2010 and 2022. What I've seen to be very, very consistent is that the actual internal rate of return ranges between 4 to 6%. I'm not expecting it to be that high today with this low interest rate. So if you're starting a policy or started one anywhere after this line, I would expect the actual IRR, just to set expectations properly, likely to fall somewhere between 3 to 5% in that neighborhood. But when the policy is properly designed, I've seen MassMutual policies produce strong actual results, not just projections. If it's not designed properly, I've seen MassMutual policies produce poor results. So when I say properly designed, here's specifically what I've seen, and I've seen this with a number of carriers. The lower that base premium is, the higher the internal rate of return has been when examining actual performance. The higher the base premium is, the lower the actual internal rate of return is. Greater adjustments occur. We've got other content that goes deeper into that. But the design, that's just my point to say, the design's critical, and I've seen it specifically with Mass and several carriers here. But when things are done right, it is a strong company. He can do a lot of damage in a good way. So that was a ton of information. I hope you enjoyed it. If you did, please hit the like button. If you watched it all the way through, please subscribe for more. Thank you so much. Reach out anytime if you have questions or if you'd like to work with us. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.